What are 10 dividend stocks that Robinhood investors are buying right now here in 2020? That's exactly what we're going to cover in today's video. Many companies so far this year have cut or suspended their dividends, so this list that we're going to go through today is going to look very different than if we did it just say 2 months ago. All the companies that I'm going to cover, these 10 companies, have not cut their dividend, have not suspended their dividend, and have maintained their dividend here, and in some cases even raised it in 2020. And in a way, this is a good thing, in my opinion at least, because it shows me that these businesses are strong. They're getting through this global issue in a great financial position here, and it gives me a lot of confidence holding a lot of these companies going into the future. It's not the case for every single company in this top 10 list, and what I will do in this video is share my thoughts on every single one of these 10 picks, so make sure to stick around until the end of this video to hear my thoughts on each and every position. Also, for this list, I didn't include any ETFs. I focused on individual companies, and I didn't include any companies that paid a yield of less than 1%. Also, you'll notice that the companies that we cover, a lot of them are going to be popular growth stocks, so it's going to be a very exciting video, guys. And if you enjoy this content, all I ask you, hit the like button down below and subscribe if you're brand new here. We have tons of new viewers on these type of videos, so if you are new, subscribe. What are you waiting for? Anyways, getting into it, I'm not going to keep you guys waiting. We're going to go through this list, and I'm going to start off with the number 1 pick and work our way down to number 10. Let's go. Kicking off the list here is a member of the $1 trillion club, most likely right now the largest company in the world, and that's Microsoft, who's been an absolute beast during these tough times. The stock is down 2.7% from its all-time highs before the global issue hit, and this is quite incredible to see. After correcting close to 30% earlier this year, it has now rebounded and is essentially flat on the year. But we're here for the dividends, guys, and Microsoft has been slowly building itself as a reputable dividend company. Current starting yield is 1.12% with 16 consecutive years of growth at an average rate of 10.45% year over year, which is quite remarkable. Their payout ratio is also extremely low at 35%, and this means that the company will continue paying and raising their dividend for the foreseeable future. And I must say, it's really refreshing to see a company like this on a Robinhood video. And guys, there are some other great blue chip companies on this list as well, and I'm excited to go through that with you. So when it comes to Microsoft, it absolutely gets my stamp of approval. I think it's an incredible company and an incredible long-term investment. Alright, let's keep this list going here with another $1 trillion club member in the house. Apple is our second most bought dividend stock here on Robinhood. The stock is down 6.5% from its all-time high, which again is remarkable considering the overall market is still down double digits from its highs. At its lows, Apple was down around 30% or so, and this has rebounded quickly as well, similar to Microsoft. Apple is a fairly new company to the dividend game though, with a 1.09% yield, 7 years of growth, but has a healthy growth rate of 10.5% year over year. Similar to Microsoft, Apple has a very low payout ratio at 26.5%, so there's tons of potential for this to grow over time. Apple is another company that I absolutely love and definitely deserves a spot in my portfolio. I think this company is going to keep growing over time. They create incredible products and they have an incredible brand behind them. And of course, who can forget the amount of cash that this company has on hand, just waiting to go out to either shareholders in the form of buybacks or dividends, or possibly for future innovation. Okay, so number 3 here on this list is technically supposed to be General Electric, but the dividend is like 4 cents a share, which is absolutely... No, we're not going to include that on this list here. We're going to skip over General Electric and we're going to go up to the next stock. So our new number 3 is Bank of America, which is one of the largest banks in America and a fan favorite when it comes to the financial space. This company has peaked right before the financial crisis back in 2008-2009, and it hit over $50 per share and hasn't found its way back since. But most recently, this company is down around 36% from its recent highs back in early 2020. Bank of America has a starting yield of 3.22%, which is a respectable yield for the banks in general, and it has been growing its dividend for the last 6 years at a growth rate of over 40% year over year, which is quite aggressive. And I don't think that this rate will continue in the future, at least not in the near future, so I wouldn't get too hung up on this right now. The payout ratio is around 47%, which is sustainable here, and I don't feel that these banks will really cut their dividends anytime soon personally. Now when it comes to bank stocks, I've discussed two other bank stocks on this channel in quite detail, quite length. JP Morgan Chase and Wells Fargo. Those are two companies that I would personally prefer over Bank of America. Nothing against this company, but I just think those are better brands. One of my favorite all-time brands and companies, Starbucks, made the list here, and I'm quite thrilled about this. Starbucks is down around 23% from its highs, and I think this is a fairly justified correction here, as it is one of the hardest hit industries from the global issue. I don't suspect Starbucks will rebound back to early 2020 levels too quickly, but I do see this company recovering in the next couple of years at most. People absolutely love their Starbucks and can't go without their coffee. Now the dividend yield for this company is 2.25%, which is quite good and in line with where Starbucks usually is on average, and it has a 10-year history of growing this dividend. The growth rate is a whopping 22%, which is quite impressive, and one of the big reasons I believe Starbucks is a good long-term dividend company. Their payout today is quite high, understandably, because their earnings are going to be poor in the short term. But like I mentioned, I believe this company and their earnings will rebound soon enough, which will stabilize the payout ratio here. Starbucks is one of my favorite companies, one of my favorite investments, and I believe even at current prices, it is fairly valued. I don't think that it's overvalued. I don't think that it's undervalued. I think we're getting a pretty good price here, but looking at this company, say in the next 5 to 10 years, these are prices that you probably would be wishing that you bought Starbucks at. AT&T is a respectable company here, making number 5 on this list, and it's especially strong in the dividend space, as many investors go to this company for safe, reliable, and consistent dividend income. Unfortunately, the company from a stock appreciation level has had poor performance since its listing. From its highs in the last year, it's down around 27%. But because of the lower price currently, you're getting a 7.22% starting yield on this company, backed by a 35-year history of raising that dividend. The growth rate is pretty poor at around 2%, but growth is growth, right? The payout for AT&T is quite reasonable here and doesn't raise any alarms for me. Now, although a lot of investors flock to AT&T for the high dividend yield, I'm personally not a huge fan of this industry, and I'm not a huge fan of the company in general. I like to focus on companies that are innovating, growing rapidly, and also as a bonus pay out a good consistent dividend. I don't think that AT&T really fits that mold, at least not for me, so it's not a stock that I would personally invest in. However, if you are looking for safe, consistent dividends, this is typically one of the top companies to own. Good old COCA-COLA, one of Mr. Buffett's favorite holdings, made the list here at number 6. It's currently down 25% from its highs, which in my opinion is not something you see very often in this business. It's a typically very slow, very consistent business, and to see it off its highs quite considerably is a rare occurrence. Coke is a respectable dividend king here with a starting yield of 3.66%, 57 years of growth, and a growth rate of a decent 5.57%. The payout ratio is high, however, Coca-Cola is a business that has prioritized the dividend throughout its history and has been through many tough times in the past, but has still consistently raised that dividend for 57 years straight. It's hard to imagine that they would cut or suspend the dividend here, and in my opinion, this is a huge priority for the business, but it will be interesting to see what happens. Coca-Cola is a strong, blue chip, safe dividend company. It's a dividend king for a reason. A lot of investors have this as part of one of their core holdings typically in a dividend portfolio. And while I do enjoy this business, I think that their competitor PepsiCo is a better value overall. But at current prices of 25% off its highs, it's hard to really argue that you're getting some good value here in a very strong brand. Surprisingly, ExxonMobil, which is an oil giant, has made the top 10 list here despite the struggles that the industry is going through right now. ExxonMobil stock is down well over 50%, and with all the issues surrounding this industry, this downturn is justified in my opinion. It's been a slow and steady decline for this company over the years, but 2020 was the last straw that broke the camel's back here. However, on a positive note, the stock yields nearly 8% right now, is a dividend aristocrat of 37 years of growth, and has been raising its dividend by around 5% year over year on average. That being said though guys, the payout ratio right now is sky high for this company, which means they're paying out more than they're earning, and unlike other industries like restaurants, I believe that the oil sector may have a very slow recovery. Other oil giants like Shell have recently cut their dividends, and many expected ExxonMobil to follow suit as well, but thus far they've held strong. Now let me be clear, these stats here is not sustainable for the company, and if oil demand remains low for say the next few months or so, there's almost no way that they can continue paying out this dividend without putting the company at serious financial risk. In my opinion, there's a huge amount of risk investing in ExxonMobil or really any oil stock right now, especially if you're investing in them for the dividends. I have a high suspicion that this company will most likely cut their dividend, follow suit with the other giant like Shell, and I think that's going to cause a lot of panic in the stock, and there's going to be another big sell-off if that does happen. But maybe on the flip side, the recent sell-off has accounted for the possibility of that dividend being cut. Not really sure. We'll have to wait and see what happens. But guys, this is not an industry that I'm interested in. This is not a sector that I like playing in, and ExxonMobil is not a stock for me. Number 8, Gilead has made headlines recently thanks to their efforts around a treatment, but the question is, does that make it a good investment? A lot of Robinhood investors seem to think so, but while we have seen a recent rally, the stock is still down 35% from its highs back in 2015. Now there's no word yet on if the treatment that they're working on will actually make them money, but buying into this company on this reason alone is not wise in my opinion. Gilead has 3.5% starting yield here, a fair payout ratio that's very sustainable, but a growth rate history of only 4 years. Now this is not a long track record, but the fundamentals of the business show that they can support this dividend moving forward. I'm personally just watching this business. I believe there's better stocks in the healthcare space offering better dividends and value, so I choose to invest my money elsewhere. This doesn't mean that Gilead isn't a good company or a good investment. It's just not one that I'm personally investing in. But based on what I see from a high level of their fundamentals, their dividends do seem sustainable, and they probably will continue growing this over time. Now this company is a new one that we've never discussed on the channel before, HALLIBURTON Company, which is the second oil stock to make this list surprisingly. This is another company that has truly been struggling, down over 86% from its highs back in 2014, and it's just been losing steam year after year since. Does this mean it's a bad investment? Well, I haven't looked at their fundamentals to determine that, but this chart does look concerning. The yield here is high at 7.5%, but quite honestly guys, I expect this to get cut most likely very soon, at least when looking at them from a high level here. There could be money to be made with this company, and maybe if oil prices rise again, they will get through this fairly quick, but a high 7.5% yield should raise a red flag, especially for a smaller business like this. Nonetheless, Robinhood investors disagree with me here. There seems to be a lot of you guys buying into this oil stock along with ExxonMobil as well. And maybe I'm wrong, maybe things do turn around for this industry fairly quick and these companies are able to sustain this dividend and grow their stock price as well, which is like a double bonus there. But for me, that risk is just not worth it, especially when you have other great companies on this list like we covered prior in this video. Now number 10 was supposed to be Nokia, but guys, I didn't feel right adding that into this list because their history of their dividend has not been looking good. They have been reducing it year over year. When looking at their charts as well, it's down almost 94%. That's right, 94% from its all-time highs. So I don't think this is a stock you'd be too upset with me skipping here in this video. So let's move on to our actual number 10 stock for this video. So we're finishing here with one of the best brands in the world, Nike, who is the king when it comes to sports apparel. Nike stock is down only around 15% from its highs, which is not too shabby here considering many feared the global issue would hurt them badly. They have held up quite strong, not just the stock, but the business as well, and I expect that to continue into the future despite this global issue. Now, the starting yield is only 1.11% for Nike, which is low, but the stock is an excellent growth performer as well, so you really get the dividend here as a bonus. They also have a growth history of 18 years, which is well on their way to becoming an aristocrat here very soon, and its growth rate has been 12.6% year over year, which is very healthy. The payout ratio of Nike is 40%, which gives them a lot of flexibility to enjoy paying their shareholders going forward, attain that aristocrat title, and have their stock price appreciate simultaneously as well. Nike is another brand that I love, and I'm absolutely thrilled that it made this list here and was able to close out this top 10. So we started out with the list with Microsoft, we ended with Nike. I'm happy here. Never thought I'd ever discuss these stocks in a Robinhood video, but you guys surprised me. And really guys, it does make me happy here that when compared to the other top 10 Robinhood video that I created recently, there's a lot of blue chip companies, premium companies on this list. This gives me confidence that a lot of Robinhood investors are looking for some premium companies, and that should pay off over time in my opinion, if you stick with a long-term strategy. Now, there's nothing wrong with lower quality companies like HALLIBURTON or EXXON, but in my opinion, I would rather put my hard-earned money into companies like Microsoft, Apple, Starbucks, because those are brands that I can see growing, those are companies that I can see growing, and I'm not risking my capital in an industry that I see shrinking over time. But of course, that's just personal preference, and as always, I love to hear from you guys, so let me know in the comment section down below. What are your top dividend stocks? Do you hold any of these top 10 stocks? Do you agree or disagree with my stance on these stocks? I want to hear all of that and more in the comment section down below. Either way guys, thank you so much for watching. Hope you learned something from this video. Hope you found some value, and if you did, drop a like down below. But either way, thanks for watching. Don't forget to invest positively, and I'll see you in the next one.